Southeast Radio's Business Matters with Karl Fitzpatrick.
Southeast Radio.
Good morning, I'm Karl Fitzpatrick and welcome to Business Matters. Well, recent research has indicated that mortgage holders who switch providers can obtain significant savings. Martina Hennessy is the Managing Director of doddle.ie and she joins me now to discuss these findings and to highlight the factors which homeowners need to consider when switching mortgages. Martina, before we discuss doddle.ie, tell us about your own career to date.
Karl, I am a qualified chartered accountant and I've worked for the last 15 years as a mortgage broker. More recently, in our new launch, which is doddle.ie, which is a specific mortgage switching service that allows customers to switch their mortgage. We offer an end-to-end service with qualified advisors.
Now, switching mortgages, that's an emerging trend that started back in 2015, but there was just over 5,000 switch mortgages last year. Why such a low number?
Yeah, and our research would show, Karl, that the real reason that people are reluctant or hesitant to switch mortgage is that, first of all, they didn't realise that they could switch, or they didn't realise how much they could save. We would also always find people saying, God, it's so difficult to compare mortgages, and they believe the process is complicated. So again, that's why we set up doddle.ie, is to make mortgage switching easier, to normalise mortgage switching, because the savings from switching your mortgage can be hugely substantial.
Now, I know that there's 7 banks currently operating in the Irish market that are actually involved in providing mortgages. How difficult is it to compare the offerings of each of those?
So all lenders will have their own rates, their own underwriting criteria, and also cashback and non-cashback offers that are on market at the moment. So at doddle.ie, what we did was we set up a simple calculator that allows you to input your mortgage amount, your term, your rate, and it compares to all rates on market. But where we really come into play is we have a team of qualified advisors that can then look at those rates, speak to you as our customer and say, okay, that works. That will work for you because your requirements are that you want a fixed rate, or yours are that you want a variable rate, or indeed you might want a cashback option. And really our role in the whole mortgage switching process is to make sure we're meeting your requirements and to walk you through that step to realise the savings that are available.
Over 75% of mortgagees are taking a fixed option on their mortgage. But some of the concern that's out there in relation to this is that what happens when they roll off that fixed onto a variable rate? How do the profile of lenders and their approach to this differ?
Yeah, so lenders all have their own different policies for roll-off rates post-fixed rates. So some lenders will all lenders will roll you onto their variable rates, but it depends on what type of variable rate product. So some lenders will roll you off onto their standard variable rates, others onto what's called a newer form of variable rate, being a loan-to-value variable rate. So that means they look at the mortgage outstanding on your property divided by the value of the property. So when we're looking at rates for customers and they're opting for a fixed rate, we'll always look at the roll-off position to say, okay, this is what your position would be now if you were rolling off that rate. This would be the variable rate. What's the position with that lender then? Do they offer the same set of rates to new and existing business customers? How have their rates been throughout the last, say, 5-10 years in terms of a profile? And just try and make sure that the customer is informed as to what will happen after the roll-off period. The other thing that's important, Karl, is at the end of the fixed period, what we're doing at Doddle and what we're doing at regular interviews with our Doddle customers is look and see, okay, when you've rolled off your fixed rate, it's now a good time to look at your mortgage again. Does your lender offer value, or do we need to go back to market? It's not that you just can switch once. You should be reviewing your mortgage constantly because it's your main financial liability, and for most of us anyway, it's their main financial commitment.
And on average, how often should somebody be reviewing their mortgage?
I suppose at regular intervals, and where your mortgage rates can change, and where your mortgage rates can change substantially, is where if your loan to value drops. So again, the loan to value question, or the loan to value percentage, is where your mortgage amount is divided by the value of your property. So in recent years, when values of properties have increased and the natural payment of mortgages means your loan to value generally decreases. So lenders tier their rates by loan to value. So less than 60%, 60 to 80% and greater than 80% loan to value. We do the brackets. So if you take your mortgage and you're 90% finance as a first-time buyer, if you hit that 80% bracket, there's a big change in rates on market, and the lower your loan to value, the lower the rate. So certainly if you hit a kind of a loan to value bracket that will bring you to the next level of rates, that's a good time to look if you're on variable rates. If you're on fixed rates, about 2 to 3 months before you roll off that fixed rate, you should be really looking to market and saying, okay, what's happening now? What rates are on offer for me? What rate is my existing lender offering? And if your existing lender is competitive, you need to assess the rates they have and move to one of their fixed or loan-to-value variable rates, perhaps. If they're not competitive, you need to look to market again. So this is not just something you do, once and then don't look at it again. It's not a quick fix. You're looking constantly at your mortgage. You're looking to try and make the most interest savings you can make on your mortgage, because it has a huge impact on the overall interest you'll pay over the term of the mortgage.
And how competitive is the mortgage market in Ireland today?
Yeah, well, you'll have seen probably over the last number of months, Karl, in particular, that the main pillar banks, including Bank of Ireland, AIB, KBC, PTSB, and with the introduction of ICS, they've all reduced their rates. So they're becoming more competitive. And that's, I suppose, because, especially at the lower loan-to-value brackets, and that's, I suppose, because they're all vying for new business, but also because even though the numbers of switching transactions are lower, they're certainly increasing. So year on year, 2017 to 2018, there was a 75% growth in switching. So people are switching. And I suppose the question is, if people are switching and you can make a saving, then why aren't you as a mortgage holder?
And what kind of cost savings can be achieved through switcher packages?
Yep, well, we have worked on the doddle.ie index over the last number of months. And based on the quarter 2 2019 figures of the average mortgage, which is 240,000 in Ireland, the savings that can be made are up to €3,380 per annum. So what that's based on, Karl, is we looked at the highest and the lowest non-discounted rate, I should add, on the market. And the differential on those rates is 2.2%. So if you take that against the average mortgage, and the difference in repayments is 281.63 per month. So that is the saving of 3,380 per annum. And they're like real, tangible, and achievable interest savings, and it's pure interest. So that doesn't add any value to you or your mortgage or your lifestyle. It's purely an interest payment that you're paying to the bank for the facility you have, and it's money that you could save, and save very easily.
And how much equity does the borrower need to have in their property to be eligible to switch?
Yep, so if you're doing a straight switch, and what a straight switch is you're just taking your mortgage from one lender to the other without adding any additional amount onto your mortgage by way of equity release, then your loan to value needs to be 90%. So that means you have to have 10% equity in your property. So if your property was worth 200,000, you could borrow 180. You could transfer your mortgage if it was 180,000. If you're looking to release equity, so you want to do home improvements, or you have educational costs for kids that you need to pay, you can release equity out of your property, but your loan to value needs to be 80% then, because it comes under the new central bank rules. So therefore, you'd have to have 20% equity in your property to be able to release equity out of it.
And from a practical perspective, what is involved in switching homeowner mortgages between providers, and how long does it take, Martina?
Yep. So, Karl, to switch your mortgage and the new lender, first of all, in doddl, we would speak with you to decide on what is the best option for you. And once you've decided on the lender you want to move your mortgage to, we go through an application process. So the first time around, people always think, oh my God, that was such an undertaking, and there was such scrutiny, and there's a lot of emotion when people are buying their properties and getting mortgages the first time around because they want to just get a home. Now you're in your home, you have control. It's a transaction to move your mortgage from one lender to the other to save money. So where we come in is we would, again, identify the lender of best fit for you. We would then walk you through the mortgage approval process. So you have to submit income docs and bank statements, which are just to show that, again, you can afford the mortgage that you're taking on. The existing lender knows that you can, and the new lender just needs to verify that everything that you have in terms of the new mortgage proposition stacks up. So payslips, bank statements, P60s need to be submitted to the new lender for approval. Evaluation needs to be carried out, and then a legal process called a certification of title. So what that means is the bank that's taking on the new mortgage needs to ensure that title is clear. So a solicitor would do that for you, and in general, the cost to switch your mortgage are generally $1,200 for legal fees and €150 for your valuation. But to be clear, all the lenders offer switcher packages, which means that if you're moving your mortgage, generally those costs are covered because the switcher packages range from value of $1,650 right up to 3% of the mortgage amount back in cash.
And finally, with so much uncertainty surrounding Brexit and the Irish economy at present, what does the future hold for mortgage rates in your opinion?
Yeah, so I suppose in my own opinion, I would expect, based on European Central Bank rate commentary, that rates are expected to stay lower for longer. So there's no imminent expectation that rates will increase. In saying that, when people come to me, they're looking for certainty. They're looking for certainty over their repayments because they're worried about Brexit. And I suppose the one thing about Brexit is that it is so uncertain and it's not going to go on a particular date. So really people are looking at fixing their rates. When people ask me what would I do, it's very much an individual question. However, fixed rates are lower at the moment than variable rates. So there's an opportunity for mortgage holders to see if they can save on their mortgage by switching, and also at the same time build in certainty over their largest financial commitment at a time which is quite uncertain.
Well, if you've just tuned in, that was Martina Hennessy from doddle.ie, and I would like to thank Martina for sharing her industry knowledge with us this morning.
Southeast Radio's Business Matters with Karl Fitzpatrick.
Southeast Radio.